Good morning, Jags. This is Fahad. Today is Thursday, June 25th. What's up, gang?
Not
Morning.
much. How's everybody doing?
All right.
Doing good. Okay, so all eyes, as we discussed multiple times yesterday in the chat room, in Telegram, and other places, is 3,000 level in the S&P. If you look at the overnight session in the S&P, the low point was 3,005. And so we're not far away from that once again. Look closely, and that continues to be the play. We bounced out at intraday in overnight session. I do not know if we're going to be able to hold that today or not because the pressure seems to be on, and the news stories about COVID-19 rising cases continue to go up. So I believe that this thing is going to break down. And if you look at SPY chart, as I mentioned multiple times already, if we lose the 300 level in SPY, then there is this gap fill down to 286 level in SPY, which equates to 2860 in S&P that remains to be filled. So that continues to be my first target. Also, simply, if you want to look at this wedge pattern that has been building in SPY, keep it simple. That's what we have in front of us, and it's this wedge. If we break this wedge, which would come with a breakdown below 300, that's a clear breakdown of the trend, and this trend actually goes all the way back to when the market bottomed sometime in late March, and we started to go up. So that's why this 300 level in the SPY is very important. If we break through that, technically, we're going to get to 286 in short term. All the market internals that I discussed yesterday are still rolling over. You can look at them in first read, and there's not much more to add to that. So the weakness is definitely spreading. And lastly, when I'm looking at pre-market action, Russell 2000 index is going to be the one that's going to continue to face more pressure, selling pressure than NASDAQ. NASDAQ is only down 0.3% versus Russell 2000 index down 1.2%. So that's where all the small cap and mid cap stocks are that are very, very sensitive to COVID-19 news. And those are the ones that are reacting the most. So for my sake, as I mentioned yesterday, I continue to look for short-term bearish opportunities in the market. So I traded quite a few yesterday in and out of positions as I saw weakness was spreading. Made a killing yesterday in Carnival Cruise, which I had both put options as well as I'm short common. And if you look at pre-market, this is once again gapping down after closing at 16. Now it's going to open below 15. So that's another 6-7% sell-off. And similarly, RCL, NCLH, all of them are gapping down sharply. Then you look at airlines. Once again, this is American Airlines. This is gapping down by another 3-4%. Delta Airline, look at this, closed at 27.34 and going to open at 26.25. So another 4% down in pre-market. And you can go down the list. You look at retail, you look at theaters, you look at leisure, any kind of thing. Disney is gapping down. So these are all the sensitive names to COVID-19 news, all the service stocks, and they're still seeing some pressure. So that's where the opportunities are. So with that said, I want to touch upon a couple areas, just high-level thoughts real quick, and then I will ask my team what they have. Kohl's, KSS. Kohl's is going to have is going to potentially break this $20 support, and after that, the next VOP support does not come into play until $17 per share. So even though it has been trending down, there is no bottom in this one, at least until it goes to 17. So that's another 15% lower than where the stock is right now. And then below that, I think it can go all the way to new 52-week low, maybe start challenging those March lows. Yesterday, management from Kohl's gave an interview to Bloomberg, and it caught my attention because of some high-level thoughts that they provided. First, on the positive side, they said that Kohl's, during the reopening phase that we have seen in the last couple of weeks, it has seen about 75% of its lost sales recover already in the stores. So basically, they're still trending down at a rate of about 25% year over year, looking at physical stores. But then naturally, on top of it, when you add the acceleration that they have seen in the online segment on a total basis, as company-wide, the system sales are down about 10% comps basically year over year. That might be positive, right? Except that now we're starting to see COVID-19 cases actually starting to go up again. So that's the first part that you need to keep in mind. But then secondly, there is one element of Kohl's that nobody talks about, which is its credit card division, store credit card division. If you go back to what happened during the 2008 economic meltdown and the recession, coal at its highest point reserved about 10.8%. It saw 10.8% of the charge-offs on its credit card division, and it was very similar, also about 10% during the 2001 recession as well. And going into this one, this is far heavier and much more retail driven, service driven weakness meltdown this morning. So the math that comes up basically shows that this time it could be as much as 20 to 30% charge-offs on its credit card division. So basically, they're not going to be able to collect on a substantial amount of its receivables that's on these credit cards, and that's a calculation that's not built into consensus views. And if that happens, I think that there's going to be further trouble down the road for Kohl's. And if we start to see more spike in COVID cases and they go back to shutdowns, that's also going to be troublesome. So I expect persistent weakness on Kohl's to continue to happen, and I think we're going to see that going forward. By the way, weekly jobless claims just came out, 1.4 million versus 1.48 million versus 1.3 million expected. So that's a terrible number again. Once again, initial jobless claims above expectations, 1.48 million versus 1.3 million. That's all there is to add there. Second thing that I want to quickly talk about is a few weeks ago, or maybe last week, I think it was, when Chronicle brought up Cummins in one of our conversations in which he talked about that this is a potential short for various reasons that he described. Yesterday, we found out that that European heavy-duty truck data came out that showed that May sales were down 58% year over year, and medium and heavy was down 56.9% year over year. This is only slight improvement from a worse number that we saw in April, but then the note also suggested that June is going to be even tougher comps month year over year. So this is just a bad number in absolute terms, absolutely a disaster number for an effect, and affects both Cummins as well as PCAR, with heavy-duty truck sales in Europe down more than 58% year over year. And then you look at this chart, and this is sitting basically near 52-week high. So if the weakness that we saw in transportation sector continues, I expect a breakdown in this chart as well. And if it starts to lose $160 support here, then there could be trouble on the horizon, with no support coming in all the way down to 150. So this is another one that I'm adding to my watch list for a breakdown. Moving on, Dow Chemical, same exact thing. Dow Chemical, the CFO, came out with a meeting with analysts yesterday in which he indicated that the second quarter EBITDA will be below the street consensus by about $350 million. Basically, this implies a net EBITDA that they expect to report of somewhere between $700 to $750 million versus street expectations of $1.1 billion. So this is bad also, because if the thought was that the second quarter has started to see quite a bit of surge with reopenings and business getting back to normal, that's not playing out. Dow Chemical is telling us that they're going to report EBITDA for the second quarter that's going to be about 30% below the consensus view. That's why the stock was acting so weak. And now this is also setting up for a breakdown. If it loses that $38 support, there's a gap fill in Dow Chemical all the way down to about 33. So another 10 to 12% sell-off that could be coming in Dow Chemical. This is also a depiction of what to expect, generally speaking, from the second quarter earnings season, because we have basically built in expectations that we're going to see very positive earnings reports and very positive commentary on the Q3 outlook, because we are building this assumption that the V-shaped recovery is here to hold. But maybe it's not happening at a pace, and it's not quite there yet. It's more like a U-shape or potentially L-shaped recovery. So this could continue to put pressure on a lot of chemical companies as well. So keep an eye on this. And then last thing I want to mention is MedTech. MedTechs have a very, very ugly sell-off yesterday. The whole group was down quite a bit, about more than 3.5% to 4% yesterday. MedTech is going to hold about this $250 support, but unfortunately, if it is unable to do this, then we could have more trouble in the horizon for MedTech as well. Now, I bring this up because I'm following the COVID hospitalization data very, very closely. And we found out that on June 23rd, COVID hospitalization was up 7% day over day, compared to the prior day, which was up 5%. So COVID hospitalizations around the country are accelerating. And if you look at it on a weekly basis in key states are 14 states, which includes a lot of the hot spots, as well as New York as well. In those 14 key states combined, COVID hospitalizations have gone up by 25% in the prior 7 days, which is an acceleration from 23%, in the 7 days prior to that. So basically, if you look at the rolling 7-day average, right? So on June 23rd, the 7-day hospitalization was up 23%, but then on June 23rd, the 7-day hospitalization was up 25%. So that's an acceleration. This potentially means negative for a lot of medtech stocks, which are very sensitive to elective surgeries. That's why you saw a pretty significant sell-off in Stryker yesterday. So you can see how ugly that chart was with a breakdown. Zimmer Biomet also had a huge high volume. Look at the volumes that we saw in Zimmer Biomet yesterday. Zimmer Biomet naturally benefits from total knee procedures. Same with the Stryker, and there's a whole bunch of category of stocks within medtechs that were affected by this. This was also my concern, even though I was going bullish on the medtech space, but in webinar on Tuesday, I talked about this, that if these COVID-19 cases continue to go up, these guys will be affected. So just giving you the broad picture on the market of what I'm seeing, and there's just simply not good positive commentary coming out for many spots. So I continue to look for spots where I can enter with with the bearish ideas, because this market is on a tilt right now. All right, Chronicle, what's up?
Morning, Fahad.
Morning.
Sticking with the bearish theme on offices, I have a long-term thematic pair trade idea in the REIT space that I'm looking into potentially for JaguarMedia. The time horizon is about 12 to 18 months, which is perfect for people like myself who can't be in front of the screen all the time. And the trade is to be long Mid-America Apartment Communities, symbol MAA, and short Boston Properties, symbol BXP. On the long side, Mid-America is an apartment REIT that operates across the southern Sunbelt states, and they specialize in suburbs and non-gateway markets where people are moving to in order to escape COVID-19 hotspots and to work from home. This is not a new theme, as the company has been experiencing rent growth acceleration from migrations even before the pandemic, which has resulted in FFO growth of roughly 6% per annum over the last 5 years. Additionally, because of how much cheaper these regions are, their operating expenses per property have been coming in well below their peers, which results in payout ratios of close to 70%. They recently provided an update at a conference earlier this month. And according to their slides, they've collected 99% of April rent and 96% of May rent in cash. To provide some perspective, the industry average is just 90% for April and a preliminary 93% for May. So these guys are tracking way ahead of their competition in this respect. Also, they have a relatively strong balance sheet with about 4.5 times debt to EBITDA versus industry average of around 5. Moving on to the short side of the pair trade, we have Boston Properties, BXP. This company is sort of the opposite of Mid-America in the sense that they deal in large-scale Class A office properties with a focus on 5 major cities, which include Boston, New York City, and San Francisco. The bear case here is pretty obvious, but if we were to look at the company more intricately, it becomes clear Boston Properties is going to feel the pain more than its peers. 3 big reasons for this. First, we have been seeing a lot of banks and companies in the financial sector saying they will make significant numbers of their employees work from home permanently, which will result in a downsizing of their offices. And when we look at Boston Properties portfolio, we can see that roughly 25% of their tenants are in the financial industry. Secondly, as I've touched on previously with Bank OZK, New York City fundamentals were already terrible before this year. Population growth there turned negative in 2017, and office demand was already declining, as shown by these charts from a Land and Buildings paper. New York City represents 35% of Boston Properties rent. Lastly, Boston Properties has 33% exposure to tech and retail companies, with a majority of it in Silicon Valley. If we assume working from home is going to persist, a lot of these software engineers and tech employees will no longer have much of a reason to continue living and paying expensive rent in this region. Redfin did a survey last month, and they found that more than 50% of respondents would move out of San Francisco if they were given the green light to work from home permanently. Separately, 60% said they would move out of Boston, which is another 33% of revenue. So put together, that's 3 separate major bear cases for the company. Leasing percentages haven't been great either, just 93% as of Q1. So looking at the ratio chart of MAA/BXP, I think this recent pullback has given us an opportunity to enter this pair trade targeting recent highs of 1.45 and perhaps beyond. What this means is if you buy common shares of MAA and you short common HPP, same dollar amount, you'll make money as long as this ratio chart goes up. So you won't even have to worry about the direction of the broader market the whole time. I can't say if both stocks are going to go up or down in this macro environment, but I can say whatever happens, MAA will likely outperform BXP over the next several months.
Good stuff. Very, very good stuff. Now you pretty much gave the everything. Are we still gonna have that presentation in JaguarMedia?
There's a bit more that I left out, but yeah, that's the meat of it. I just covered.
Okay. Fantastic stuff. I'm looking forward to then doing the presentation for JaguarMedia, where we will cover a lot more stuff. This chart is indeed in a very steady uptrend of higher highs and higher lows, and particularly your thoughts on that short case about Boston Properties is a very interesting one. Good stuff, Jay.
Hey, Fahad. So just one stock today, Generac. GNRC is the ticker.
Yeah.
So we last covered this name in the May 17th weekend research, and really the bulk of that note was, it's hurricane season. It started on June 1st, and actually there was a hurricane that was approaching prior to that date. So one of the reasons why we covered it. And then we provided some channel checks on the home standby business, which is Generac's biggest segment. But the reason why I'm bringing it up today is because UBS has an initiation note out, buy rated, they go street high, $145 price target. And if I can just quote the analyst here, they say Generac's well-timed entry into the US residential solar and storage market comes as storage deployments are set to grow fivefold from 140 megawatts in 2019 to 700 megawatts in 2021. We forecast the clean energy business to account for 7% of Generac 2020 domestic residential sales and 47% of net sales growth 2019 to 2024, driving a multiple re-rating for Generac. Underlying the clean energy upside is Generac's less volatile core residential standby power business, within which Generac holds a 75% market share. And this is a topic we actually covered. If you go back to the Q3 2019 outlook in key debates, specifically related to California. So this is a small segment right now, but certainly poised to grow. And if I can just add one more item, on June 22nd, Roth Capital was out with a note after their solar webinar, and they say that Generac is a new entrant that both Enphase and SolarEdge have to watch out for. As one participant put it, the sentiment for me has really transitioned from this is a SolarEdge Enphase fight to if I'm Enphase, I'm a lot more concerned with how I'm competing with Generac.
Oh, wow. That's interesting on the Enphase comment. Aren't we in the hurricane season now? So
Yes.
and this thing lasts all the way until November, right?
Yeah, it's October, November, yeah, somewhere in there.
Yeah.
And so that's always the tailwind. You know, if you get a serious hurricane or tropical storm, Generac is always the default stock people go to.
Yeah, and one last question. With the view that's in front of us, have we seen any kind of material sales disruptions from COVID in the second quarter that we should be concerned about going into the second quarter, which will be our earnings report sometime late July?
You know, I haven't. When I talked about Generac on May 17th, the recent checks there from Oppenheimer were positive, and
Okay.
that was related to the home consultations and the home generator business.
Sounds good. This has been a pretty good win for us. Multiple
Yeah.
times, actually, we have endorsed a bull case ever since we produced this in the quarterly outlook 6 months ago. And so more than 6 months ago. Good stuff. Avo.
All right. We talked a lot about a lot of stocks, so in the chat room and everywhere else. So it was kind of hard to pinpoint something that we hadn't talked about. I did see that Vail Resorts, MTN is the ticker. There was a buyer of 250 August 170 puts. Now this could be just a hedge against a long position or some other position, but we generally don't see much going on in this. And they paid it was $770 in any case. I can't remember the price, but it was the ask price. Tried hard to find some reason for it, and I can't say whether this is just a trade on momentum with everything else that is leisure related.
This is probably a bearish bet, just because, you know, most of the times, I don't know if it's necessarily a hedge, but most of the times when something a little bit out of the money, and it's paid far enough in time, you know, they're speculating on a technical breakdown. A hedge would be something more simple, more at the money, and more, you know, catalyst focused. I do see it that they bought those 250 plus of the August 170 puts yesterday for $7.30 offer, when the bid and ask was $7.10 to $7.30. And this is also just like similar to a lot of the recreational stocks that are being affected by COVID. It's right at support right now.
And it's unusual because we don't see buying often in this. Now, like I said, I don't have any concrete reason except just speculation, perhaps on everyone's part about recreational activities. They have operations that are opening as of this week and into the beginning of July, like the outdoor summer themes of their winter resorts with limited capacity. Also, the Australian ski season is opening very soon, I think as of next week, with limited capacity. So I mean, it could just be a technical play, or it could be a play on, more restrictions. Now, I mean, their locations are in Colorado, Utah, British Columbia, Vermont. So it's not like they have hills in Arizona or California, although they might. No, I don't think they do actually. So that's the one that I wanted to bring in, just to keep an eye on this possible.
Yeah, they're also, by the way, they have also been accumulating October 145 puts. So you see
Interesting.
So that's the open interest of about 400 here. And they actually bought some of those yesterday as well. That's farther out of money. So that's why when I see bets like this is not a hedge. Nobody goes out 15, 20% out of money and then buys something as a hedge. And they have been gradually accumulating that position since June 16th, which is way out of money in the October 145 put. So I think if you just cut the noise and keep it simple, we will probably get some channel checks on this one rather soon. But important thing is that it's threatening to break down through this bear flag through 180, and if it does that, the next VOP support doesn't come into play until 156. Potential almost 10% to the downside that could be had over here on a breakdown. So that's I think what the play is here. All right, great stuff. Good technical observation there. We're going to stop here. Thank you everybody for joining. We'll see you in the chat room shortly.